All you see, all you see is violence in movies and sex on TV. But where are those good old family values? Stop being a broke loser and fix yourself today. And fix yourself today. Okay, let's read this book. So, when we've last left off, this was a few weeks ago, I was reading chapter 2 and I finished chapter 2. But today we are going to do chapter 3 of this book. And I see that my audience is liking this book more than they're liking Wealth, Poverty, and Politics, so we're probably going to stop reading that. Um, but this chapter is called Risk Mitigation, which is probably like insurance, I'm guessing. So we are going to read Risk Mitigation. So, risk mitigation is the next step for your terrible financial habits. Risk mitigation is achieved through insurance products that protect your family from financial hardship. Worried about dying prematurely and leaving your family in poverty? You need life insurance. If you still have children living with you, a mortgage, other debts, and you are the primary breadwinner, you need it. Life insurance is the first thing you will buy before you do anything else. Do not like it? Tough. Personal finance is not about buying stocks. You can either remain a broke loser or take the first step on the path to financial security. Worried you might become totally disabled on the job? You might need disability insurance. Yes, it will cost you some money, but it is necessary in some scenarios, especially if you are the primary breadwinner. Wondering who will take care of you when you're older? Look into long-term care insurance. Do you not screw over your kids by forcing them to pay for your long-term care needs because you were too busy blowing all your money on shoes to a long-term care policy? No, I do not sell life insurance. I do not have any sort of commission for recommending life insurance. I have zero affiliation with any life insurance company. But I demand you will buy a life insurance policy to protect your family. If you refuse because it's too expensive, or you have better things to do like buy your 15th pistol for your gun collection, then toss this book in the trash. You are a lost cause. If you trust me and decide to buy life insurance, you want term life insurance. Ignore the scummy salesman who sells you whole life, universal life, or any variant of the combination of cash value life insurance. If you are content, an agent, to buy a term life insurance and start a policy talking about a great investment or amazing tax advantage benefits, stick your fingers in your ears and repeat la 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 until they stop. Tell them you are buying term or you are out. Anything other than term is a complete waste of money and will divert dollars from the more important things into a terrible product. You want to maximize the amount of money you have for a cash management and investing components for your financial plan. Investing in whole life or universal life will eat up a large part of your disposable income and make it next to impossible to achieve your financial goals. The next investment component of your life insurance will also be garbage in comparison to lowest cost stock mutual funds, but we will get back to that part later. With life insurance, with term life, you can easily afford to purchase an amount of coverage you need to protect your family for a set period. The term is the cheapest form of insurance out there because it does not come from any gimmicks or special components. It is insurance in the pure sense. You do not want the most vanilla, you want the most vanilla, boring term policy you can get from your appropriate amount of time you need it. You die, your family gets your death benefit. It is that simple. Avoid additions to your policy to increase the cost, known as riders. Insurance companies will throw these to raise the premium and their profits for garbage you will not need. Insurance is a necessary evil that will put a small dent in your monthly savings potential, but and you must make every possible effort to keep insurance costs low as possible. The less you spend on life insurance, the more you can divert as much money as possible into growing your wealth. Term life insurance protects you from a set period. If you die, the life insurance pays a death benefit to your beneficiaries. For example, if you get $1 million, if you get a 1 million 30-year policy, the maximum you pay a level premium. Let's say for $40 a month for 40 years. As long as you pay that premium every time on month, the policy stays in effect until the expiration date at the end of the 40-year term. If you die within the 30-year period, your beneficiaries get $1 million. It should say dollars, but this is 1 million. If you do not die, you lose all your insurance coverage and stop paying the premium at the 30-year mark. If you want to renew the term insurance after that, your premium cost will skyrocket. But that is irrelevant because after 30 years, you are self-insured and you will not need life insurance anymore. Term insurance protects your family for a fixed period. If you have someone that is dependent on your income, or if your family would need more money to offset something you are providing to the family free of charge, like being a stay-at-home mom, you need a term life insurance policy. When you are young, you do not have enough assets to be self-insured, which means you need to buy life insurance. Self-insured means that you would have enough assets to fully protect your family without insurance. Imagine if you had $10 million in the bank with no debt and your family only needs $2,500 a month to sustain their current standard of living. Would you need life insurance? Nope. Not that you couldn't still buy a policy within a $10 million in the bank, but your family would not need to depend on it to survive. If you had a job or to watch your kids at home, had a mortgage, car debt, and any other type of debt, you didn't have money set aside for your family indefinitely with their current standard of living, you need enough life insurance to pay off all debt and support your family in a current standard of living. Think about what would happen if you died without insurance right now. How would your surviving spouse pay the mortgage? How would your family replace the income loss because you died? Even if you are a stay-at-home parent, you need enough life insurance to pay for daycare. Stay-at-home parents provide real economic benefits that are being replaced with insurance if the parent dies. Many insurers determine how much insurance you need, but you can do it yourself. If you decide to have an insurer or agent help you, it's best thing to do it online, so you don't have to deal with any pushy salesman who's trying to sell you any garbage that you don't really need. Most websites will ask you a series of questions about your income and lifestyle to determine the amount of coverage required. A good rule of thumb is your life and death benefits to be 10 times your annual pre-tax income. You may need much more than that depending on your debt level and personal circumstances. Do not scam on the amount of insurance just to save money. It is crucial to protect your family. Only broke, selfish losers do not buy adequate life insurance so they can afford to spend money on some other asinine thing, like a new fishing pole or their daily dipping tobacco habit. You need to have life insurance through your employer, but it will probably not be enough to cover your needs. You need to shop around for the best insurance rates with a minimum of 3 quotes from different insurers to get the best deal possible. www.policygenius.com is a great resource to compare different insurance quotes, or you can go directly to each insurer to get a quote. I will remind you again, only get term insurance. You will not need insurance for your entire life. Your mortgage will be paid off after 30 years. Your children will go through college and move out of the house. Your retirement nest egg will grow to a point where your spouse can live off the balance alone, even without your income. Term can cover 30 years, which is an ample amount of time to pay off your mortgage and get your kids out of the house. Between term, it is 10 to 15 times cheaper than whole insurance and frees up much more money for you to invest in your retirement goals. If you have to pay $60 a month for $1 million in coverage or $600 a month, thought so. Do not get stuck into some scammy financial salesman who is trying to convince you it is a great idea to pair investing with insurance. Any money put into life insurance product is not directly correlated to the cost of insurance that can generate returns through your own investing. Life insurance agencies are just out to make a fat commission of your ignorance. Investing is investing, insurance is insurance. Keep them separate. If you apply for a large life insurance policy, sorry, I'm terrible with indirect articles. I need to continue reading. I'm terrible. I keep skipping the A's. You are probably going to need a medical exam. Companies will issue some policies without a medical exam under certain amount of death benefit coverage, but your policy will most likely not be enough to fully protect your family. For larger policies, generally over $500,000 in death benefit, the insurance company wants to understand how healthy you are before you issue a policy and risk of millions of dollars. These exams consist of qualified professional taking your height, weight, blood pressure, blood sample, and urine sample. You answer a laundry list about your current medical conditions and lifestyle. The insurance wants to know if you skydive, fly single airplanes, scuba dive, and many other things about you. They want to know your parents' health, any medical conditions that may have other family history. The medical exam questions seem invasive and like overkill, but it makes sense. The insurer is taking on risks, paying hundreds of thousands of dollars or even millions of dollars to your family if you die. If you die over the policy term. Insurers are in the business of making money and they want to mitigate as much risk as possible by understanding your current and potential future medical needs. Do not lie on your application. If you do, your family's death benefit may be considered reduced, and that is also called fraud. Based on your medical exam, your insurer will offer your policy to a certain monthly cost or premium. Your premium is generally lower the younger and healthier you are, and it will vary by insurance company. If you get married, start a family, or have anyone dependent on your income, you want to get a policy as soon as possible. Do not wait until you are old, fat, potentially uninsured before you consider a policy. The insurance company are not obligated to insure you and can reject your application altogether, depending on how risky you are. Once you purchase your life insurance policy, you will need to do today, because you've made the decision to break free of the broke loser mentality. The next consideration will be disability insurance. Disability insurance replaces a portion of your income if something happens to you and you cannot work. Disability insurance is not workers' compensation or workers' corp, although it serves a similar purpose. Workers' corp laws are different in each state, but they generally replace a portion of your income, usually 66%, if you are injured at work and cannot perform the job. If you are injured outside of work, you are not going to receive workers' comp. If your workers' comp is also a finite payment period, where the disability insurance steps in. Disability insurance replaces a portion of income if you've been unable to work due to injury or illness, regardless of whether you are on the job or not. How much income replaced based on how much you specific in your policy. More income. The more income you want to be covered, the more you are going to have to pay. Disability insurance can either be short-term or long-term. You do not need short-term disability insurance if you follow my advice and have some emergency savings set aside to cover several months of of essential expenses. Like insurance, you can be self-insured from a short-term disability. If you have enough money, this allows you to skip overpaying premiums. Oh, hold on. I'm laying down now because I'm tired. Oh man, I've been reading for a long time. Overpaying premiums and do not need investing in assets instead. Disability insurance should cover the income to keep your family afloat if you lose your job. Your monthly bills are essentials like rent, mortgage, food, utilities, health insurance should be covered by daily insurance. Your Netflix or tanning subscription do not fall into that category of essential bills. You can budget in the non-essentials, but you are going to have to pay more for your premiums if you do, which you do not want to do because you want as much money as possible going towards assets that will generate you more money into the future. Disability insurance is a necessary evil, but you want to minimize your payments so you only are paying for what you need to survive. Okay, let's read this part now. You should check your employer and see if they have disability insurance plan as part of your employment benefits. While you may have some coverage through your employer, it may not be enough to meet your needs. You may need to do research and buy a policy through a private insurer if you need more coverage. If you're not sure about all considerations of disability insurance, call up a larger insurance career and talk to an agent. Do not meet one of them in person. It is a lot easier to say no to someone over the phone if you think they're selling you a load of BS than it is to say face to face. Most people buy products, do not need them because they are pushed into them by pushy salesmen. If you are determined you need supplemented long-term disability policy from the private sector, make room in your budget and buy it. You do not need to wind up permanent disability and broke. Disability can happen to any of us when we least expect it, and it can derail even the best laid financial plans. You may not think you need long-term disability insurance, since you can count on the good old Social Security disability insurance to swoop in and save the day. That is just plain dumb. The average wait time to get a hearing to qualify for SSDI is 538 days. Imagine waiting over a year to qualify for disability benefits when you have reduced your income coming in or no income at all. You would be screwed. On top of that, SSDI claims they've rejected 53% of the time. That is straight out of the Social Security Administration itself. So if your plan is to rely on SSDI, you are resisting your hopes on a ridiculous wait time and have a 50-50 chance of claiming your claim will be past scrutiny. Compared to long-term disability insurance, what is the average waiting period? The average waiting period is 90 days before it begins to pay out benefits. Long-term disability insurance covers much more higher percentage of your income than SSDI and much more likely to be approved. On average, long-term disability insurance replaces 60% income, while SSDI only pays you $1,197 per month. Long-term disability will keep you from living the rest of your life in abject poverty. Want to avoid risk of a lifetime of poverty and begging Social Security to get a small place to survive? Pay 1 to 3% of your income for a long-term disability policy. Check out www.policygenius.com for a quick estimate on the levels of coverage that will cost you. Long-term care insurance is the final consideration for your risk mitigation strategy. But when you or your parents are in your late 50s, a LTC policy is a wealth-preserving insurance that will mitigate your risk to drain your life insurance on long-term care expenses. This applies to both you and your parents. If you do not have a policy, consider getting one. If your parents are getting older and do not have much money, you need to discuss the policy with them. A LTC policy can save you from blood-sucking burden on your children and grandchildren do not have any wealth accumulated for retirement. The most selfish, disgusting things a person can do is live irresponsibly their whole life, not saving any money, and deciding to purchase a LTC plan because I could not afford my cruises if I paid premium, and then becoming a financial burden on their kids when they become too old and cannot support themselves. When an elderly parent has no money, no LTC insurance plan, and becomes too old to care for themselves, it will cost their children an untold thousands of dollars to support them, not to mention the stress the kids have to go through to reorient their lives around their helpless parent. Elderly parents will not drain their children's financial future, but their grandchildren's as well. Mommy and daddy will need to cut college savings for their kids because grandpa blew all their money when he was younger and did not have the foresight to purchase a long-term case policy. If you are in your 50s and reading this, you need to do research on LTC. If you're in your 20s or 30s and your parents are in their 50s and 60s, you need to sit down with them and talk about their long-term care plan. You may be surprised to find out your parents' long-term plan is an integral vampire. If that is the case, now it is to prevent that from happening. Long-term insurance is designed to cover long-term services and supports, including personal and custodial care that varies settings in your home, a community, organization, or other facility. The average cost of a policy in the United States is $2,727, but it may be much higher or lower depending on your age and health. If you are getting old and are unable to perform at least 2 activities of daily living, ADLs, bathing, dressing, eating, and LTC policy will provide you a daily benefit for a certain amount to defray the cost of assisting care at a nursing home, assisted living facility, or at home care. For example, if you buy a policy that covers 5 years of assisted living expenses up to the maximum of $200 a day, the premium of your policy will vary depending on your age and your health when you purchase it. The daily amount of your policy will cover your health care and how many years the policy will pay out and many other factors. Basically, the more risk you are to the insurance company, the higher premium they will charge. For example, women tend to live longer than men, so expect a women's LTC premium to be higher than a man. You do not need to buy a policy in your 30s or 40s. Your decision to purchase a LTC plan can be put off in your late 50s and early 60s. Once you get into your 50s and early 60s, you need to decide quickly whether you're going to need a policy or not, because every year that goes by will need to increase your premium you will need to pay. It will also increase the likelihood you will develop a health condition that you will need undesirable and putting your family at risk for huge financial losses. Your main consideration is looking at a LTC policy if you're in your wealth accumulation by your late 50s. If you have to delay with saving, you will have several $1 million saved up for retirement. With much wealth, your risk of dependent on your retirement savings to pay for LTC is low. In that case, LTC is not a retirement, but is still an option if you want to guarantee to pass on a significant percentage of your wealth to your heirs. If you have a few $100,000 to your name, it will be 50-50 proposition. You will have nothing saved for retirement because you blew all your money on BS. It becomes necessary. How much skipping over LTC insurance policy cost you? On average, a person at the age of 65 or older will have a 50-50 chance of needing LTC. If they are uninsured, they will pay on average of 140,000 out of pocket. 13% of people of some form of assisted care need LTC for 5 years or more, while 48% will need LTC for 1 year or less. 63% of people will not spend a dime on assisted living their whole lives, while 9% will spend $250,000. Overall, 1 in 4 people will spend more than $40,000 in LTC costs. What does this mean? As I said previously, if you or your parents have nothing saved for retirement, you need to purchase a long-term care policy. That is better than every chance that your parents will not need to use an LTC policy at all. But if it does happen, your parents are broke, you are in trouble. If you don't, you may need to upend your life and drain your savings to support your family financially. Your irresponsible parent, or you will drain your own children for some reason to need assisting living later in life. If you have a retirement nest egg in the millions, you are self-insured and will be better off investing in premiums instead. Think Medicaid or Medicaid or Medicare will save you? Think again. Medicare will only pay you a portion of your skilled nursing facilities for the first 100 days of the hospital administration. After that, you're on the hook. If you're not reimbursed for long-term custodial care, or the care does not require skilled care, such as skilled nursing services, physical therapy, and other types of therapy. Basically, Medicaid will pay temporarily for skilled medical services, but they aren't going to pay for the next they aren't going to pay for a caretaker to come to your house every day for the next 5 years to empty your waste bin and get you dressed. Medicaid is a long-term care services, but to qualify, you need no wealth and have an extremely low income. For example, in 2019, the income limit was set to $2,300 per month of assets, limiting to $2,000 for an individual. To qualify for Medicaid's long-term services and supports LTSS, unless your long-term plan is to have a crap income in retirement and have no income savings whatsoever, you are not going to qualify for Medicaid. That program is designed to people who are desperately in poverty and truly need the government support. Do not be the piece of scum to try to manipulate the system by gifting away all your wealth to your family just so you can qualify for Medicaid. Risk mitigation is an important part of your financial well-being. Insurance is a necessary evil that eventually will be phased out of the budget once you accumulate enough assets to be self-insured. Unfortunately, most people will not accumulate a significant amount assets to be self-insured until they diligently invest in assets over decades. In turn, you must protect yourself with insurance. When you are forced to spend money on a liability, i.e. insurance, you want to find the best value for your money. This frees up so much income as possible to invest in assets without leaving yourself open to huge financial losses. Long-term insurance is the best value for your money. It provides you all the protection you need for the lowest cost. Long-term disability insurance will protect your family from a loss of income during your working years until you have acquired enough wealth to support yourself without working. Long-term insurance protects you from draining a portion of your accumulated wealth savings when you cannot take care of yourself anymore. It protects your children and grandchildren from having to foot the bill for your long-term care if you do not have any assets. This stops you from draining your descendants like an intergalactic vampire. Okay, now we're on chapter 4, investing, but I'm tired, man. I'm not going to read tonight anymore. But man, there's a lot in here. Basically, I don't know if you listen to my voice, but basically he's basically saying that risk mitigation is insurance, and you should not mix up insurance with investing. That was the gist of the chapter. And when you're doing insurance, it's mainly because of your family, and you want to protect your family at all costs first, and then you secondly. And so disability insurance will be the second priority, but term life insurance will be the first. Some people absolutely hate the idea of term life insurance because they think it's a scam. Once you're done paying, you're done paying it. I mean, yes, it's either a sum all or nothing at all. Kind of like you get something or you get nothing at all. And that's insurance. It's in risk. They do a fancy calculation. It's not like gambling. Most insurance companies are out there to make money. So they are looking for a way to calculate risk. I totally agree with Mr. Christopher Allen on this. Man, I've been watching some of his newer stuff too. I was watching his stuff about Joseph Carlson. He's absolutely correct about Joseph Carlson, how he closet indexes. Anyway, that's besides the point. By the way, that's the guy who runs the YouTube channel. Christopher Allen Bell runs the Strongman Personal Finance YouTube channel. But I find this book to be so fascinating. It has bigger font. That's what I love about this book. But I find it, his language is a bit hard to read still. It's not as hard as Rob Berger, but it's easier to read than Rob Berger, definitely. But it's harder to read than some other people. I don't know. It's not. He uses simple words, but the way he structures a sentence is so different from the way I would structure a sentence if I was going to be writing a book. It's not a hard book to read by that measure. It doesn't seem like it doesn't seem like a college kid's writing this book. It seems like a dyslexic guy's writing this book. I know that's a kind of an insult to him. But you read it and he's got like it got periods that's just not in the right places. He's got like his paragraphs are sort of like run on a little bit. He formats the paragraphs pretty well. But I love the font size. It's big. It's a very big font size. Each chapter is like a 30-minute read. Oh my god. The investing chapter alone is going to be a lot, I think. Yeah, what is it? 30 pages. That's going to be like a minute a page almost. Oh my god, chapter 5, Don't Invest Like a Dude. Bro, I'm just looking at the chapters. But we are going to read this whole book. I mean, my goal in this channel was to read this whole book. Wealth, Poverty, and Politics I'm not going to read. Because I'm not going to read Wealth, Poverty, and Politics anymore. Because people aren't watching that. They like Christopher Allen Bell. They seem to really enjoy his stuff. And I don't blame people. I mean, he's an index guy like I am. He buys the same index I buy. I buy VT. He buys VT. He kind of gave me the idea to buy VT. Not gonna lie, I did take his idea. But I buy bonds too. So it's not like I'm more conservative than he is. He's a big stock guy. I'm not as big as I'm just big on indexes. As you can tell, I have 9 books from John Bogle. I mean, if Christopher Allen Bell wanted to interview an index guy, I would be the number one guy he would... Look, I got so many John Bogle books that it's not funny. I mean, it is funny. Look, Stay the Course by John Bogle. Like, honestly, if I would be an honor if he would interview me. I know I'm a little bit of a mess of a person, and I'm not organized at all. But I'm going to read your whole book, Christopher Allen, and I'm going to stalk you. And no, I'm not going to stalk. But it is a very interesting book, and I find it. I've never written a book, and I don't know if I ever will. I want to write like a normal investment economics book, similar to Human Action. Like it's going to be like it's got to be its own theory though, independent of most economic theories. But I want to talk more about like the prison system, like this one talks about, like the evolution of everything. But yeah, if I was going to write a book, I don't know if I'd write it in the same style as Chris, but he does seem to get this big font, and I really love that about him. It's just, I feel like when I'm reading, I don't know why, I feel like it's still hard to read. I mean, I don't read out loud, so for me, this is it's hard for me to read out loud. But I want to just read the chapters and listen to that. Like, I want people to listen to them, because this book doesn't have a voice. When you go on like Audible, there's nobody reading this book. So if I get my voice, if I'm reading and I get put on Audible, like if I get paid to put on Audible or whatever, I'd be so happy to do that. But anyway, that's besides the point. You are someone and I'm someone else. Reading Stop Being a Broke Loser. I'm going to be reading chapter 4 next. Goodbye.